Mhm. I feel some people should take some chips off the table. And not only is the market really expensive, but you already talked about the bond market. Highest interest rates in 20 years in that ballpark. Again, of course, interest rates are still below their long-term average since the 1950s. But if you look at the yield of the treasury market, it actually is higher than the stock market's dividend yield. So you're not even getting paid for that volatility risk in the equity markets. I think there is consideration for fixed income, but I also think that there is consideration for other asset classes and that you can consider non-equities, kind of the alternative space. So there's a lot of things that fall underneath the alternatives bucket. There's also real assets. And the beauty of alternatives and real assets is that if you look at sort of the historical experience when the stock market is expensive, but when the bond market has higher than average volatility, which makes sense because inflation has been higher than average, inflation volatility has been higher, and then you have all the geopolitical risk, all the uncertainty. When you have all those conditions in place, you typically see real assets and alternatives provide not only an attractive return, but they diversify portfolios powerfully. And I think
So
that
you bring
investors
it
should give that more consideration.